We're here to talk about Silicon Valley real estate market geographically, and these are the things we're going to be going over. This is the how you control what you go to. I'll go over both of those at the end. Here's the first status slide. What we're doing here is we're comparing the active inventory today compared to the 10-year median. And when you have 68% in the case of South County, that means you only have 2/3 the inventory that you typically do for this time of year. It's red in color because the lack of inventory favors the seller. Flipping over and looking at the number of offers accepted, it's basically the same number, 65%. In this case, low number of offers favors the buyer. There's less competition, and you can see there's basically a shortage of offers across Silicon Valley. Then the key is really the ratio between the inventory and the offers. If there's a huge inventory and there's a huge number of offers, you still have a fast-paced marketplace. If you have huge inventory and half the number of offers, then you have a very slow marketplace. So in East San Jose, you can see that the market's 31% slower than it typically is, which means even though there was a shortage of inventory, the shortage of inventory is less severe than the shortage of offers. Then you flip over and you go down to Cupertino and Sunnyvale, and it's the reverse. There they have a greater shortage of inventory than they have of offers, and therefore it's a very fast marketplace. It's 30% faster than it typically is. And you can see the slowest area is the San Mateo County coast, almost twice as slow as it typically is, or twice as much of inventory as it typically is. Now we're getting rid of the 10-year median, and we're simply looking at the raw count today. The raw count today is simply a theoretical number of how fast the market is moving. Basically, you can see that Cupertino Sunnyvale would sell out everything on the market at the current rate of sales in just 11 days. The expensive areas in San Mateo County take 120 days. So basically a factor of 10 difference. That's why it's important to look at the micro markets. You know, if you were looking for a home in the expensive areas in San Mateo County where you're taking 4 months to sell the inventory, the negotiation platform is completely different than if you go into Cupertino and Sunnyvale, where you expect to sell out all the inventory in just 11 days or a week and a half. Now, for those that like simplicity, I'm looking at days on market. But if you look at average days on market, there's a problem with that statistic, that metric. And that is if one seller sells after being on the market for a year, which does happen, then that brings up the average. There's also a problem with the median in the fact that it jumps. In other words, it will stay at 8 days for a long period of times, then 9 days for a long period of times, and 10 days. And you can't see if the market's improving or worsening based on that metric. So what I look at is the time it takes 75% of the sellers to sell. And again, red favors the seller because it's quick. And you can see that if the bulk of Santa Clara County is selling in about a week and a half, yes, there's 2 areas that are taking 18 days. You go into San Mateo County and the bulk is just about 12 days, with San Mateo County coast taking 50 days. And you go, well, wait a minute, how can the days on inventory be 120 and the 75% of the sellers sell in 50 days? They're two different metrics. They're related and they're going to go up and down very similarly, but the days on the market only count of those sellers that are successful. So if you have a listing that comes on the market that doesn't sell, that counts as inventory on your days of unsold inventory. It does not count on the days on the marketplace, because I'm looking at offers accepted time on the marketplace, not the time of the listings on the market. You know, it depends on what you're measuring the days on market on, but I'm looking at offers accepted because that's where the market is. These are the people that are realistic. Now we're flipping over and looking at the seller's expectation, and we're measuring that by what's happening with the seller's ask price at the time the offer comes in compared to their original ask price. In the case of Milpitas, North Valley, Blossom Valley, and Santa Teresa, sellers are actually raising their price by 0.8%. Now, that is not sellers raising their price by less than 1%. That's a few number of sellers raising their price by 10% or whatever. And that happens in 2 cases: data entry mistakes that I don't catch, or more commonly, a seller actually raising the price. And that happens in 2 common themes. One is where the offer comes in much higher than the agent or the seller was expecting, and they actually raise their asking price, thinking that that helps the appraisal come in closer to the offered price. The other one that happens is there's a lot of this marketing pricing where someone will price a home at $999,999 to keep it under $1 million, thinking that's going to bring in the buyers and they're going to bid the price up. Not every one of those attempts is successful because they've misread the market or there's something wrong with the property or whatever reason. And then after a week or 2 weekends, you see those sellers raising the price up to like 1150 because they realize that they're not going to get a bunch of offers to bid up the price, so they better get their price back up to closer to what they're willing to accept. On the flip side, you can see both Oakland and the San Mateo County coast are negative, and again, these are not sellers reducing their price 1.5% and 4% respectively, but it's a smaller percentage of the sellers reducing their price significantly. And basically, when we move on to the next slide, which is the frequency of those price reductions, you can see that in Santa Clara County, a good lot of the areas are around 5% of the sellers are reducing their price. That means 95% of the sellers aren't reducing their price. Yes, there's some areas that are approaching 15%. It's 85% or more of the sellers in Santa Clara County aren't reducing their price at all. And you can say that same statement true pretty much across all my 20 micro market areas. The two exceptions are just slightly higher. San Leandro, and Hayward at 15.6%. So just 0.6% above that, and Oakland at 16%. Oh, I didn't see it. There's the San Mateo County coast, which is clearly the slow marketplace with 23%. So almost 1 in 4 sellers reducing their price. But if you ignore the coast, you can basically say only 85% of the sellers aren't reducing their price at all, and it's only 15% that are. Now we're flipping over, leaving seller price adjustments, moving over to overbidding. And so now we're looking at what the buyers do to, get their offer accepted when they sense that there's multiple offers or their fear of multiple offers. Because if you know there's no other offer competing against you, you're going to go in and offer the ask price. Basically, in Santa Clara County, you can see a good portion of the area is getting about 10% above their asking price. In San Mateo County, it's a little bit more varied, anywhere from a reduction in the coast, almost a full percent reduction, to a 11.5% increase in Redwood City. And Alameda County is a little bit more like Santa Clara County in the fact that you have some areas, basically the more affordable areas, down around 7% or so of the overbid, and then you go into the bulk of it and it's around 10% overbidding. And so again, this is the magnitude average, including those going under and over ask price, of what the buyers are doing. So this is the buyers' perceived competition. And here's the frequency. And again, it's sort of shocking to see 85% in Santa Clara County of the sellers are getting more than their asking price. Now, of course, I'm generalizing because South County's down there at less than 50% of the sellers are getting more than their ask price. And if you move up into San Mateo County, it goes from a low of 25% of the sellers getting overbids. So only 1 in 4 sellers are getting anything over. And then the rest of the valley or the county is between 2/3 and 85%, more or less. And then you go over into Alameda County and you actually have the highest number in Fremont of 90% of the sellers are getting more than their asking price. Clearly an aggressive marketplace, and clearly, again, a market that's divided, because there's got to be a difference between only 25% of the sellers getting over asking price to 90%. And that's why putting everybody in a blender and looking at county-wide data or Bay Area-wide data, which is 9 counties that touch the Bay, really gives you garbage numbers as far as actionable items. Now, this is looking at the appreciation since the last 9 months of 2015. I picked that period. I was trying to get a whole year, and I was not successful in doing that, where prices were relatively flat because I wanted to get a nice solid base. So I'm comparing everything to the last 9 months, last 3 quarters of 2015, and comparing present value to that value back in 15. And you can see that Milpitas, Berryessa's got 108%, and the biggest one is Union City and Newark at 111% appreciation. The lowest areas are right around 50% appreciation. And we'll see a graph later on where we're comparing the Northern California counties, and we can see that San Francisco is really taking a hit compared to the other areas. Now, instead of just following the median price, which is the middle number, I sandwich it by looking at the cheapest 10% and the most expensive 10% or the 90 percentile pricing. So you can know the range in the different geographical areas. And here, red color is not associated with the market conditions, but it's just this indication of what is where the more expensive areas are. And you can see that the more expensive areas are still in the southern western portion of Silicon Valley. And the cheaper areas are the more outlying areas along the eastern portion of Silicon Valley. Now, here's a summary of what we went over. I'm not going to go over in great detail, but the yellow highlights are your current market indicators. So basically, these 5 columns are sort of strong indicators of what the market's doing today. The orange highlights are where the market was when the offer was accepted, which is basically 4 to 6 weeks ago for the most part. It gives you an idea where the market was versus where the market is. When you're negotiating an offer, you want to know where the market is today. And then you can look at where your areas of appreciation were. And it's sort of interesting seeing the concentration not only on the map, but also geographically, the way I've gone through the Silicon Valley. There are areas that are seeing the least appreciation are grouped together, which is, they could have been in a different order, but this is the order I picked, which, was logical for stepping through. And then your price range. And for the first time, I've added in what the payments are. And this assumes an 80% loan using the national numbers for 30-year fixed jumbo money. Now we're taking those 20 micro market areas and just putting it in a blender. This is what you want to pay attention to if you're just trying to see what Silicon Valley is doing. And look at the big dip here in the gray line. What we have down at the bottom here is the inventory in the purple. So you have a limited inventory. And again, you can see the dip in inventory going into the holiday, which was Good Friday, Easter, and Cesar Chavez back at the end of March. And then you can see we rebounded out of there, and then we've improved a little bit. You can see the demand in the orange has continued to just climb. Yes, it dipped down going into the holidays, but it's been climbing right through the holidays. This table is mostly for the bottom line. And basically what it's doing is it's showing that we're having the second least number of offers accepted. The only year where we're worse is 2020. And as we all know, that was the year that we had the pandemic and we had shelter in place. And it's going to continue to be 2020 for a while. But it's just interesting to know we're second only to that. And, we're going to get even more significant because right now you're almost 50% more than that previous low. But that was an artificial low where they basically said you couldn't show houses. Here's just what the payments are doing for the typical homes in Silicon Valley. The gray is the absolute typical median home. The blue is the cheapest 10 percentile home, and the red is the most expensive. And this combines price and interest rates. So payments are now lower than they were basically back the last quarter of 2023, but they're higher than they were for most of the time. So, it just gives you a reference. Payments are what most people buy houses on, and that's why I put payments on here. Now what we're going to do is look at weekly distributions. These are the seller ask price reductions. We have the green dash dotted line up here. That's the current week. And basically 53 weeks ago, which was, comparing the same week of last year to this year, was down here. So the first takeaway is from last year on the blue dash dotted line to the green dash dotted line shows you the market's significantly better. The other thing that we're going to do is we're going to start off a year ago, jump a month at a time, and then we're going to go a week at a time when you get to 3 months, which is 13 weeks. The next slide will be 12 weeks. Here we're stepping through. So there's a year ago. And so now the trend in the future this year, months is down. That was the bottom. Now you can see the run up this year, clearly going weekly. Now start paying attention right there. Right there's the peak, down, down. So you've had the peak 2 weeks ago. Last week was down a little bit, and this week's down a little bit from last week. So what's this saying? It's saying that sellers are getting used to the run up in the marketplace that we've had, and their expectations now are more in line with the marketplace. It doesn't necessarily mean the market is slowing. It just could mean that the sellers are now raising their expectations so that they're meeting the market better. There's more data in 2024. What are 2024 prices going to be? Or it could be the market's beginning to slow. It's just the amount of price reductions is no longer continuing to decrease, but it's sort of, we'll go back. There's the peak. and there's last week, and there's this week. So last week's there, and you can see there's very little difference between last week and this week. But, it's basically saying the expectations are getting more in line with reality. Now we're flipping over and we're seeing what's going on with the demand. And again, the green dash dotted line is the current data, and the blue dash dotted line is last year's data. This data tends to lag behind, and you can see the purple line is going to be, the thin purple line is going to be last week's data, and you can see we're up pretty much higher. And if I'm saying that basically 2 weeks ago is when the seller expectations got in alignment, that may start showing up in the sale price in another 2 to 4 weeks. And we'll only see. If it starts happening with overbidding, that will tend to say that buyers have sensed the cooling of the marketplace. Stepping through, there's a year ago where we were, and we were basically at the plateau at this time a year ago. Now you're going down, now 12 weeks, 10 weeks. Now you're going to start ramping up. And then coming up right here's the purple, and there's the green. So you can see the green is higher than the purple. So the overbidding is still going up. Now what we're doing is looking at the active inventory compared to typical, the gray line, and this allows you to see the annual cycle. So there's a huge difference. If you just talk about inventory, it gets really low at the end of the year, and it gets really high in the midway through July, early August, and you need to pay attention the same time of the year. So you can see the pattern. The blue line is a cool marketplace, so that's the most inventory you'd expect. And the red line is the least inventory you'd expect. And you can see the current data is basically right down very close to the red line. So we're behaving normally. The other thing I want to point out is basically right here on January 1st of 2023, I blow out the scale so you can see it. You have one complete year so you can get a sense of the scale, and then the current year. And before 2023, going back to 2014, I have a much more condensed, so you have a pattern. But if I kept the same scale, you wouldn't really be able to see the nuances. So it's a little different. I'm not sure too many people do this, but I think it's a way of expanding the timeline for the last 2 years, the last year and a half. Now what we do is we pull out that gray line and make it a straight line. And we're basically saying the data is hotter than normal, and you're somewhere around 75%. So 25% less inventory than you normally would expect. Now we're doing the same thing with the offers, and just like at the first geographical map slides, we had a shortage of active inventory. We also had a shortage of offers. Here, a shortage of offers is a cool marketplace, so you're much closer to the cool marketplace. Now, the dip down here is caused by the pandemic, so that's why this artificial decrease is happening, and you really wouldn't expect that to happen. And if you come back and look at the blue line before the pandemic, it wasn't there, and you can see that after the pandemic, it starts getting there, because this is a moving 10-year median. So you can see that in 2023, I'm impacting it, and it didn't impact the data in 2022 and 2021 like you might think it would. And the reason for that is I didn't have 10 years of data. Now it's impacting it, and I'm getting rid of the earlier years. So the impact is more significant. And then the red up on top is where you have a lot of offers, and we're clearly a far cry from there. And you can see in 2021, we had a huge surplus in the number of offers, which is why the market took off. Now we have a shortage of both. Here's the same concept where now the gray line is pulled out straight, and you can see that you got about 82% of the offers you'd expect. And since the offers has a higher percentage than the inventory, that gives you a faster moving DUI. And here you can see the DUI is faster moving. It should be up here on the gray line, and it's not, it's halfway between, or a third of the way towards the red line. It's favoring a hot marketplace. But again, you can see the annual cycle, and you can see where the data is now, and you can see the impact of the holiday weekend. Basically, every holiday negatively impacts real estate, because real estate is an optional event, and when people have social obligations, those social obligations sometimes take priority and slow down the real estate market. There are two exceptions, and that's Mother's Day and Valentine's Day, where apparently the nesting urge overtakes the need for social interaction, and there's actually a slight positive on those two holidays. Here's the days of unsold inventory. You can see the rapid drop off that basically after we got through the holidays. Here's the days on market and see the step functions here. This is the drawback of the median, and it would be more severe. And you can see it now, it's impacting my data. So ideally, I would have taken maybe the 70th percentile or maybe the 67th percentile instead of the 75th. But at some point, you got to go with a number and look at it. And you can see the steps are pretty short. The median are for longer periods of time. But again, what it tells you is you have a fairly fast moving marketplace with 75th percentile being close to the record fast speed. Here's the number where you can see you're about 80%, so you're selling about 20% faster than you typically do. Here's the seller's expectations where you look at their ask price compared to the original ask price, and it's actually below the line. So sellers are taking larger price reductions than normal. Now, pay attention though, this is a very tight metric. This is 100%, 99% is down here. So right now you're talking about 0.4% reduction because that's the average. And because it is such a tight, well, first I stretched that out and you can see that on a percentage basis, it's right there. And then when you stretch out and because it's a tight metric and because 85, 90% of the sellers don't adjust their price at all, you don't want a lot of data with zero because that just makes it, like an anchor. I'm now looking at only the 10% of the sellers that are taking the biggest price reduction. And again, you'd expect to be up here on the gray line and you're vertically down here on the purple line. So you're a good half, if not more, towards the pool marketplace. So sellers are actually taking bigger price reductions right now than they typically do for this time of the year. And here you can see it, they're taking somewhere around 35% larger price reductions than they typically do. And again, this is only the 10% that are taking the biggest price reductions. And you can see that going back here, you can see the huge impact from the meltdown we went in first quarter of 2022. And it's actually interesting because if you look at this data, it starts right on January 1st of 2022. And most of the data really indicates the market turnaround in February. But the sellers were taking less and less price reductions. So the market was accelerating. And then right around February, all of a sudden the sellers started taking bigger and bigger and bigger and bigger and bigger and bigger and bigger price reductions. So, and then you can see where the market started improving right at the beginning of second quarter of 2023 as the amount of price reductions started to go down. Here's the frequency. Right now, the frequency of the price reductions is basically right on top of the gray line. So you're having essentially a normal marketplace. And at this time of the year, you only expect about 8% of the sellers to be doing price reductions, which means 92% of the sellers are not. Here you are, so you're having slightly more price reductions than you'd expect. Here's the average overbid. So we're flipping over now and we're leaving the sellers and we're doing what the buyers are doing. And normally the buyers are down here. Basically, we're just past second quarter dividing line. So you're normally down here somewhere right about where my cursor is. And instead of the typical 6% overbid that you'd expect, you're up here at something like 9.5% overbidding. So they're 3.5%, 50% higher than you'd expect them to be. And here you can see there's the 3%, 3.5% over what they typically are. Here's the frequency of overbidding. And again, the overbidding is a little more common. You'd expect it to be down here on the gray line. So you'd expect it to be right about where my cursor is, about 72%. And instead you're up here around 76%. And that's coming in and saying we're about 4% above. 6 minus 72 is 4%. Maybe it's even 5%. The scale on these graphs is hard to get quick on the fly, but you can see that you're towards a hot marketplace with more frequent overbidding than you'd expect for this time of the year. Here is price. This is on log paper, but you can see the dip at the end of the year and the straight shoot up. And we're not quite up to our peak pricing back in 2022, but we're getting darn close to it. Here's the graph of the active inventory. Now what we're doing is we're breaking away from Silicon Valley as a whole, and we're trying to look at what Silicon Valley is doing by the regions. San Mateo County is going to always have the least because it's the smallest county. You can see Alameda County and Santa Clara County are very close together. But if you come back, the last couple of years were roughly the same magnitude, because you have to go down here to first quarter, end of first quarter. But then if you go back further in time, in 2019, you were way up here. In 2018, you were down here, reasonable 2017. So it's roughly split. If you go back to 2014 through 2016, the level of inventory was much higher. So we're in about the normal level of a tight inventory is what I would call that. Here's the offers accepted. Again, your Santa Clara County is greater than Alameda County. And if you look historically, I would say that the two are closer together, and Alameda is normally on top. So the demand for offers is much higher in Santa Clara County right now than it is in Alameda, which is not typical. Here's your days of unsold inventory. And because of the higher offers in Santa Clara County, it's got the lowest speed of the marketplace measured in days of unsold inventory. You can see it's about 21 days. Alameda County comes in about 29 days, and San Mateo County is coming in at about 31.5 days. So you can see the three counties are completely different. And basically the concept here, it depends on what you're doing. If you're trying to get an indication of what the market's doing, you look at all of Silicon Valley. If you're just trying to do what your local county is doing, then you look at the county data. And if you're actually trying to buy or sell real estate, then you have to look at the individual micro market areas. Here's the related data, days on market, and this is included just because it's simplistic to understand. How long are the long typical sellers taking to sell their property? And you can see in Santa Clara County, it's the least amount of time at 12 days, followed by San Mateo County at 14 days, and Alameda County is the slowest at 15 days. But you go anywhere else in the country, and you say 75% of your sellers are selling in 2 weeks or less, they would say that's a fantastic marketplace. We've never seen anything like that. Here's the magnitude of the seller price reductions. You can see Santa Clara County is taking the least at very close to 100%, because now this is 95.5. So that's 0.1% price reduction on average. Alameda County and San Mateo County are basically tied. If I was to read it, it looks like San Mateo is sneaking up at 99.45%, and Alameda County is probably closer to 99.4%. Here's looking at the seller ask price reductions. San Mateo County is actually doing the least amount of price reductions. You can see that Santa Clara, the blues turnaround have gone up, and Alameda County is taking the most and has turned up. San Mateo County is going down right now and not following the same shape as the other two counties. And those are the kinds of noteworthiness. You can see that it went up here where the other two counties sort of went down and back up. So San Mateo County is an upside down U, and Alameda County and Santa Clara County are a right side up U. Here's the magnitude of the overbiddings. On average in Alameda County and Santa Clara County, buyers are going up roughly 10%. In San Mateo County, it's basically, it looks like 6.2% above the seller's ask price. And again, this is average. You can't go in and say that you're going to pay 6.2% above the seller's ask price and get the property, because the property might have been priced low. Basically, you have to ignore the seller's list price and try to look at what the market value is. Here's your frequency. San Mateo County has the least. Santa Clara and Alameda are basically tied at just under 80% overbiddings. So that means that something like 78% of the offers are coming in over ask price. Here's the long-term appreciation. You can see Santa Clara County is doing the most at just over 200%. It looks like it's about 203%. And that means 103% appreciation since 2015, because you have the original value. In Alameda County, it looks like it's about 92%, and in San Mateo County, it's about 78%. Here is the long-term pricing. This is on log paper. You can see San Mateo County is getting close to their record high. Santa Clara County is much closer. You only got a tiny little peak right here where the prices were higher, and Alameda County is in between the two. So we're almost getting back to the point where we're going to be in record high pricing point, and we will probably get there in the next couple weeks. Same information on regular paper for those that prefer. Here's the estimated payments. So San Mateo has the highest payments. Santa Clara and Alameda is the cheapest. That's the more affordable county out of the three. Here's the actual raw numbers. So you can look at Santa Clara or San Mateo or Alameda County, or you can look at complying data. You can look at whatever metric you are, and you actually have the numbers so you can read the actual numbers. And I also have, in addition to the appreciation since 2015, I also have it since 2020. Now we're leaving Santa Clara County and Silicon Valley and looking at the Greater Bay Area. This is measured in 5 regions. You have Silicon Valley as region number 1, the cities number 2, North Bay 3, Central Valley 4, and Central Coast number 5. Here, starting off with the numbers, and just for clarity, the reason I have April 12th on here, that's the day I gathered the data. I'm gathering the data through midnight Thursday, gathering it on Friday, presenting it on Saturday, the 13th. Here is the active inventory, and you can see the inventory has gone down dramatically for all the areas. It's much clearer in the North Bay and the Central Valley because their lowest numbers, no matter what year you pick, even in the years where Silicon Valley is close, there's a big drop off there. So there's been a huge drop in North Bay and Central Valley, where you can at least say that Silicon Valley is close to its record low levels. And the drop off is also pretty clear in Central Coast and the cities. This is looking at the number of offers accepted. Silicon Valley has the most number of offers, and this is just raw count. North Bay and Central Valley, and then the cities and the Central Coast. This is looking at days on sold inventory. You can see the trend is basically downward. It typically is down at this period of time. You can look back last year and it's going to start leveling off and then eventually start increasing. So we're basically at about the fastest paced marketplace for the year. Here's looking at the marketing time. You can almost start to see the leveling off in Silicon Valley. I would also argue that you can see it in the North Bay, and Central Coast is starting to level off, but still down. Your cities and Central Valley are still in the downward trajectory, but you know, if all ships go up and down the same, it would be changing here shortly. Here's your price reductions. Silicon Valley has the least, followed by the Central Valley. The other three are very close together and be almost impossible to tell which is worse, or you know, how close together they are. This is the frequency. Silicon Valley has the least. The cities is the second least. Central Coast, North Bay, and then Central Valley has the most price reductions. This is the overbidding. This is where buyers are coming in and overbidding by the largest percentage. I believe that part of the reason Central Valley is low is people are going out there for affordability, and so they're willing to overbid, but they overbid by a smaller amount. But you have the cities in Silicon Valley very close together, then you have North Bay, then you have the Central Valley, and in last place is the Central Coast. The Central Coast is more laid back, maybe because it's not much of an economic engine. Here's the frequency of overbidding. You can see Silicon Valley is the most, Central Coast is the least amount of overbidding. You can see the order of your particular region. Here's the grand appreciation. Here's where you start seeing the separation. This is San Francisco and Marin. You can see the appreciation is only at 50%. Compare that to Silicon Valley, which I think was 102%, 102% appreciation, or 202% of the value it was in 2015. Here's the sold price. You got the cities just slightly more expensive than Silicon Valley. Silicon Valley is weighed down by Alameda County to some degree. And you can see that the Central Valley is the most affordable out of the 5 regions. This is the monthly payments in the same order as price, because I'm going through the same formula to get there. And then what we've been talking about now is Silicon Valley real estate market, week number 15. We're April the 13th. So to get a handout, you put in what I call the green root URL, which is right up here. That gets you to the archive, or if you don't want to trust my link, just go to the YouTube archive link, which is up here at Silicon Valley Real Estate Data. You add in 2024 to get to the live presentation Saturday morning. Add an H, the year, month, date code, and you get the handout, and it is up there. 64 slides. I got rid of some of the duplication and some of the very similar graphs, but we go through about 110 slides in the last 35 minutes. And then to any specific episode, I'm Richard Calhoun, Creekside Realty, real estate broker here in Silicon Valley, willing to work with buyers or sellers. This has been a presentation of Silicon Valley real estate market geographically of single family homes. It's the most current. Basically, the data's through Thursday morning and it's presented on Saturday. That's pretty fast turnaround. It's the most comprehensive. There's many different metrics. I don't know if anybody that offers more. In fact, if anybody knows of another metric I should be following, I'd be happy to look into it. And I also correct the data. There's a lot of data entry errors and a lot of duplicate listings on more than one MLS, and I delete those. I search and do a pretty good job of getting them all. I may miss one or two, but I am deleting almost that I can find. I use a 5-week period because I believe real estate has a huge weekly cycle caused by weekend showings versus most people report calendar month dates. Calendar months are also important because you have months like February
that have 28 days. And then you have other months that have 31, but they also have different number of weekends and weekdays, which has a huge impact. And that varies from year to year. By using a 5-week median, I'm comparing the same week all the time. And my year, because of leap year, starts on March 1st. And then I look backwards. So I go from March 1st, I jump forward 7 days at a time. When I get around to February 21st, I jump forward 8 days back to March 1st. Except in leap years, I jump forward 9 days, and that gets rid of the fact that we don't have an even number of weeks. I look at offers accepted versus pending. The problem with looking at pending transactions, which most of the other people that analyze the marketplace do, is if you're in escrow for a longer period of time because you're having buyers having a hard time getting the loan, that particular transaction impacts the statistics for a longer period of time than the offer that comes in with cash and closes in 1 or 2 weeks. I look at 20 micro market areas, and that's what I start the presentation off with. I then look at the combined Silicon Valley. I then come back and look at the 3 counties individually, and those 3 counties are Santa Clara County, San Mateo, and Alameda counties. I then move on to the Greater Bay Area, made up of 5 regions, which include 13 counties here in Northern California. I look at the supply, the demand, and the balance compared to their 10-year medians. So you have an idea of whether you have more or less inventory for that period of time. I then look at the current supply demand ratio. That's the speed of the marketplace you're going to see right now. On days on market, time to sell, I look at not the median and average as most people do. The average has a drawback of when one seller that was on the market for a long time sells, after a year or two, he really brings up that average. And the median has a problem because it's so low, there's a lot of step functions. So I have taken on the 3/4, the 75th percentile, and reported what that person's doing. It gives you a very sensitive measure that moves up and down almost all the time smoothly. However, when you do get a very fast marketplace, you do get the step function that I try to get away from. I look at the seller's expectations versus market conditions, and I measure that by looking at the frequency and magnitude of price reductions. I then look at the buyer competition, and I look at that again by the overbidding frequency, magnitude, and frequency of overbidding. I then look at the appreciation since 2015. I elected to go with a 9-month period of time because I wanted a stable market. And one of the things you quickly learn about Silicon Valley is the first 3 months of the year is when you see some pretty radical price changes. And therefore, I eliminated that by looking at just the last 9 months. I picked 2015 because it was back in time and it was fairly stable in pricing. I look at the low, typical, and high price instead of just the median. So you have a sandwich effect. You know what the total price range is. And then I bring in the total monthly payment, including PITI, principal, taxes, and insurance. And I'm assuming an 80% loan and a 30-year fixed rate loan using the national average. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley since 1981. Happy to reach out and talk to anybody that wants to discuss real estate. Thanks. Have a great week. Bye for now.